Well, this is going to be a report that I would not want to be a USDA analyst trying to come up with the numbers, because USDA is already taking significant hits about their crop reporting processes and how the numbers are really affecting the market adversely and now has support. So there's a lot of confidence problem with USDA now, and there's a real pressure afoot to basically get it right. The crop condition ratings are on record for corn and beans have historical corrections over the last 30 days, would suggest yields significantly lower, that it's almost beyond the belief that USDA could lower that much. I would say the trade right now in corn is at 130 and thinking we could eventually end up at 120. A yield below 136 would be considered, 2 weeks ago would be considered bullish, but now would be considered bearish. I would say the market, USDA is going to have to get a yield probably below 130, be considered a positive number, and if it's below 127, it would be a bullish number. If they would come down where Informa came in last week and said 120, if USDA would actually do that figure, which would be in line with the 83 and 88, 28% drop in yields, with 88 and 83, 28% below 10-year trend line would suggest a 113, 114 yield. This market would be explosively higher Friday and Monday, Tuesday. So I think right now the risk clearly is on the upside for exposure. If you're short the cash market and you want protection, I like buying a call to defend. If you're long the futures, I like the position, but you can't let it go below 780, and absolutely 765 is your line and stand on the downside. If the market would gap above 820, I think that will cause another big move in the market. But once we get to 875 to 925 level, I think the board will be pretty much start exhausting itself, and the final high in this market will be put in very much by the cash market. And I could see historically some of the highest basis levels ever recorded as the cash market rations. But I think this is going to be a market high, very similar to the 1996 behavior, not like the 88 or 83 behavior. 88 and 83 were very quick, short highs, 2-month engagements. The 96 high was over a 5-month high, and I think this is going to be a longer time period. So if you got cash unpriced inventory to sell on 012, which is contrary to how I ever would say, I think now you're in the driver's seat. I wouldn't want to get it below 760 on the downside, but I would trail yourself with stops below the market for at least until December and let yourself breathe and see what the room can be done. Beans, on the other hand, is the commodity that I have the greatest anxiety of predicting, because it's heavily dependent upon the yield. Stocks are global are extremely tight, and a small change in yield is going to have phenomenal impacts on beans, because beans are so much more harder to ration. If we was to go as low as the trade is taking to 36, you could be seeing a significant yield variance in price to the upside. But I would challenge you, with these August rains, the crop's going to look better. So, and I don't think USDA is going to come back and surprise us with a big yield drop in this report. I think we're all going to wait and see confirmation, which means the biggest variance in bean price activity is probably more in the October, November, December time period, enough to entice South American production, but too early for South American production to have impact. So the biggest rally potential in beans is probably between October and February is when you'll see the high in beans this year.